Right now, in December 2025, silver is trading at approximately $62 to $63 per ounce on the futures market. That's what the ticker says. That's what financial news reports. But here's the problem. You can't actually buy physical silver at that price. Walk into a coin shop or check online dealers, and you're paying $75 to $80 per ounce for basic silver rounds. Popular coins like American Silver Eagles are going for $85 to $90. And for many products, there's a 4 to 6 week delivery wait, if they're available at all. This is called a supply chain break. The paper price says one thing, but the physical reality is completely different. And this gap, this $15 to $25 premium over spot price, reveals something breaking in the commodity markets. This isn't just about silver bugs or precious metals speculation. This is about what happens when paper markets, futures contracts, disconnect from physical markets, actual metal you can hold, and why that disconnect signals deeper problems in how commodity pricing actually works. This is the story of why silver's supply chain just snapped, what's causing the massive premiums, and what it means when financial markets stop reflecting physical reality. Let's start by documenting what's actually happening right now in December 2025. On the COMEX, the major commodity exchange where silver futures trade, silver is quoted around $62 to $63 per troy ounce. This is the spot price you see on financial websites, news tickers, and trading apps. This price represents futures contracts, agreements to deliver silver at a future date. Most of these contracts never result in physical delivery. They're traded by banks, hedge funds, and speculators for financial exposure to silver prices without actually handling metal. But when you try to actually buy physical silver, generic silver rounds, $75 to $80 each, that's a $13 to $18 premium over spot, 20 to 30% markup. American Silver Eagles, official U.S. mint coins, $85 to $95 each. That's a $23 to $33 premium, 37 to 50% markup. And for many products, there's a 4 to 6 week delivery wait, if they're available at all. This disconnect isn't normal. Historically, premiums on silver rounds are $2 to $4 over spot. American Eagles typically carry $4 to $7 premiums. Current premiums are 3 to 5 times normal levels. Something has broken in the supply chain between the paper market, the COMEX, and the physical market, actual metal you can hold. So what's causing this? Why can't you buy silver at the official price? Factor 1, industrial demand surge. Silver isn't just a precious metal, it's an industrial commodity. About 50% of silver demand comes from industrial applications. Solar panels. Silver is essential for photovoltaic cells. As solar installation accelerates globally, climate goals, energy security, industrial silver consumption is spiking. Estimates suggest 140 to 160 million ounces annually for solar alone, up from 110 million just a few years ago. Electronics. Every smartphone, laptop, EV, and electronic device uses silver for circuitry, contacts, and conductive elements. As electronics production grows, so does silver consumption. Medical applications. Silver has antimicrobial properties. It's used in wound dressings, medical devices, and water purification. Post-pandemic, medical silver demand has increased. EVs and batteries. Electric vehicles use significantly more silver than internal combustion cars, roughly 25 to 50 grams per EV versus 15 grams for traditional cars. With EV production growing, this adds millions of ounces of annual demand. All this industrial demand is inelastic. Manufacturers need the silver regardless of price. They can't just substitute another metal easily. Silver's conductivity and properties are unique, so they buy at any price. Factor 2, mine supply constraints. Unlike gold, where annual production roughly matches demand, silver has been in a supply deficit for several years. Global mine production is 880 million ounces annually.
This hasn't grown significantly because most silver comes as a byproduct of copper, lead, and zinc. You can't just mine more silver, it's tied to other metals production. Annual demand is about 1 billion plus ounces. The deficit is filled from above-ground stockpiles, scrap recycling, and investors selling, but those sources are finite. Primary silver mines take 7 to 10 years from discovery to production. Even if silver prices doubled, new supply wouldn't come online until 2032 to 2035. Factor 3. Refining and minting bottlenecks. Even when raw silver is available, turning it into coins and bars requires refining and minting capacity, and that capacity is maxed out. The U.S. Mint, private mints like Sunshine Minting, and government mints worldwide are running at full capacity. They can't instantly increase production because equipment and dies have throughput limits. Quality control requirements slow production. Labor shortages in skilled minting operations. Raw planchet production can't scale instantly. So even though silver exists, it can't be turned into retail products fast enough to meet demand. Factor 4. Investment or hoarding demand. As inflation concerns persist, currency instability continues, and geopolitical tensions remain high, investors are buying physical silver as a hedge. When people buy silver coins or bars for wealth preservation, they typically hold them, don't sell back quickly. This removes metal from circulation, tightening supply further. Additionally, some investors are buying because they see the premium gap and expect either the paper price to rise to match physical, or they expect physical premiums to stay elevated. All these factors, surging industrial demand, constrained mine supply, minting bottlenecks, and investment buying, have created a physical shortage, while the paper market, the COMEX futures, continues trading based on contracts that mostly don't require physical delivery. The result, paper price says $62, physical reality says $75 to $80. Here's the question. If physical silver is genuinely scarce and selling for $75 to $80, why doesn't the COMEX price just rise to match? This is where commodity market mechanics get important and controversial. Here's how the COMEX futures market works. The COMEX silver market trades contracts representing 5,000 ounces of silver each. Traders buy and sell these contracts, and the price is determined by supply and demand for the contracts, not necessarily for physical metal. Only about 1 to 3% of COMEX contracts result in physical delivery. The other 97 to 99% are cash settled. Traders close positions before delivery, taking profit or loss in cash, never handling actual metal. This means the paper price is set by financial traders, banks, hedge funds, and algorithmic trading. They're focused on speculating on price movements, hedging positions, or executing trading strategies. They're not concerned with physical supply and demand. Large institutional players can sell massive contracts to push prices down or keep them suppressed, even when physical supply is tight. This is legal market making and hedging activity, but it can create distortions. The manipulation debate. Some market observers argue that large banks with short positions in silver futures have an incentive to keep paper prices down, even when physical markets are tight. They point to historical cases. In 2020, J.P. Morgan paid $920 million in fines for manipulating precious metals markets through spoofing, placing fake orders to manipulate prices. Multiple banks have been fined for similar practices in gold and silver markets. The argument, if banks hold large short positions, they profit when prices stay low, so they might use their trading power to suppress futures prices, even when physical markets are tight. The counter-argument, futures markets serve a legitimate price discovery and hedging function. Large players provide liquidity. Prices reflect expectations of future supply, not just current physical availability. The truth is probably somewhere in between. Futures markets can disconnect from physical markets temporarily, especially when contracts are mostly cash settled and physical delivery is rare. And large players can influence prices through legitimate trading activity. But regardless of intent, The result is the same. The paper price doesn't reflect physical reality.
So what happens when paper markets and physical markets diverge this severely? Palladium, 2000 to 2001. Paper prices diverged significantly from physical. Eventually, the gap closed violently. Palladium spiked from $300 an ounce to over $1,000 an ounce when physical shortages forced paper market repricing. Rhodium, 2020 to 2021. Extreme physical shortage while paper markets lagged. Eventually, rhodium went from $4,000 per ounce to $29,000 per ounce, a 7x increase in under a year. Nickel, March 2022. The London Metal Exchange had to halt trading and cancel trades when nickel spiked 250% in a day due to a physical shortage/short squeeze mismatch with paper positions. In each case, the disconnect didn't last. Eventually, one of two things happens. Outcome 1. Physical premiums collapse. If paper prices are actually correct and there's no real shortage, physical premiums eventually fall as supply catches up with demand. Dealers get inventory, premiums normalize to $2 to $4 over spot. Outcome 2. Paper prices spike to match physical. If physical shortages are real and persistent, eventually the futures market must reprice. Traders demanding physical delivery force the issue, and paper prices rise to match physical reality. Which is happening with silver? The evidence suggests physical shortages are real. Industrial demand is documentable and growing. Mine supply is constrained and can't increase quickly. Minting capacity is maxed out. Premiums have stayed elevated for months, not a temporary spike. This points toward outcome 2. Eventually, paper prices will have to rise, but timing is unpredictable. These disconnects can last months or even years before resolving. So what do you do with this information? First, understand what you're actually buying. If you buy physical silver at $75 to $80 an ounce, you're betting that either paper prices will rise to match physical, closing the premium gap upward, or physical premiums will stay elevated long-term, meaning you paid market price for scarce physical metal. If paper prices rise to $75 to $80, you win. Your silver is worth more. But if physical premiums collapse back to $2 to $4 and paper stays at $62, you overpaid and are stuck with metal worth less than you paid. Second, recognize the supply reality. The physical silver supply chain is genuinely stressed. This isn't manufactured scarcity. Industrial demand is real, mine supply is constrained, and minting can't keep up. This doesn't guarantee prices will rise, but it does mean physical availability is limited. If you want physical silver, you'll pay premiums or wait weeks or months. Third, don't confuse paper markets and physical markets. When someone says silver is at $62 per ounce, ask which silver, paper contracts or physical metal. They're trading at different prices right now. If you're an investor, understand which market you're actually exposed to. Silver ETFs, SLV, PSLV, these track paper prices, futures. Physical coins or bars, these trade at premium inclusive prices. Mining stocks, these correlate to silver prices, but also depend on company operations. Fourth, watch for resolution. This disconnect will resolve. Either premiums collapse or paper prices rise. Watch for dealer inventories improving, suggesting supply catching up. Premiums narrowing to historical norms, suggesting shortage easing. COMEX delivery demands increasing, suggesting physical tightness forcing paper repricing. Industrial buyers securing long-term supply contracts suggests they expect sustained tightness. Fifth, be skeptical of narratives. Both silver bulls and bears have strong narratives. Bulls say physical shortage proves manipulation, prices must explode. Bears say elevated premiums are temporary, fundamentals weak, speculation driven. The
The truth is usually more nuanced. Supply is genuinely tight, but that doesn't guarantee a price explosion. Markets can stay irrational or disconnected longer than expected. Silver is trading at $62 to $63 per ounce on paper, but you can't buy physical silver at that price. Retail premiums are $15 to $25 over spot, delivery delays are 4 to 6 weeks, and dealers are running low on inventory. This is what a supply chain break looks like. When paper markets, futures, disconnect from physical markets, actual metal, it signals stress. Industrial demand is surging, mine supply is constrained, minting can't keep up, and investment demand is strong. Eventually, this disconnect resolves. Either premiums collapse because supply catches up, or paper prices rise to match physical reality. Which one happens depends on whether the shortage is temporary or structural. If this changed how you understand commodity markets and the difference between paper and physical prices, hit subscribe. Drop a comment. Have you tried to buy physical silver recently? What premiums are you seeing? And share this with someone who needs to understand why the price on their screen doesn't match the price at the coin shop. Because when financial markets disconnect from physical reality, someone's wrong, and understanding which market is telling the truth is critical. I'll see you in the next one.